All right, everybody, we're here live again. Last show of the year. We know that got some holiday stuff coming up the next couple weeks, but we have a great show to end the year. We have Richard and Elliot with Alphi. Al as far as the animal, and Phi for financial. Correct?
That's correct.
All right. Well, tell us a little bit about yourself and how you guys got into this business and how we can help people save money on their taxes.
Yeah, all right. Well, so we actually have a pretty interesting start for two guys in the financial business. We actually met each other, 9-10 years ago?
Yeah. I was coming from the vacuum cleaner business.
And I was coming from the military.
Okay.
And we met doing what?
Slinging roofs.
Slinging roofs, going door to door, chasing storms. So it's I don't think there's too many guys that started off going door to door storm chasing, selling roof siding, windows, and gutters, who are now in the financial business. But
There we are,
right? So we do everything every other financial firm does, but a lot of things that they don't. And the reason for that is because we did something unique in the financial space. We were somehow able to manage pulling attorneys, CPAs, investment advisors, and insurance guys all together in order to create more of a team approach to analyzing somebody's particular tax situation.
One-stop shop, baby.
Yeah, right. And so it's kind of like in the roofing business, right? You got guys that can put a roof on, but then you got guys that can actually navigate the insurance claims process, and employ the software like AccuLinks, right? Xactimate, right? And actually provide a much greater value for their client than just putting a roof on, right? Mm-hmm. So that's kind of the same approach that we took from the roofing industry and applied to the financial industry. And it's been working out pretty well. And so that's one of the things we wanted to kind of talk about, especially since it's the end of the year. A lot of times people are coming down to the end of the year. They're going to their CPA. They've especially this year, hopefully, have made a lot of money, cash flow pretty well. And they walk in, they talk to their CPA, and what does he tell them to do? To save taxes.
Go buy trucks, trailers, and whatever else you can.
Right?
Yeah. Spend money. And some of that money they can't write off fully.
Yeah, right. And I think that people feel like there should be better options. Mm-hmm. People just don't know what they are, right? And so today we thought we'd take a few minutes of your time and introduce you to one of those options.
All right, real quick, we have a comment from Brandon Whitten. He says, "Hey boys, thanks for the insight."
Awesome. All right, thanks, Brandon.
Hey, Brandon.
Well, hopefully by the time we're done, your mind will be blown.
My mind was blown. Just reading the post, it was blown. And then when I had a meeting with you guys the other day, it was we discussed some stuff, and it was like, why can't you just spend money this way? And now there's a legal way to do it. It just takes you a year, but we'll get into that. Are you guys ready to share your screen?
We are.
Okay. Get your Excel up and
all right. If you see our screen, it should just be a big whiteboard.
Yep, we got the whiteboard.
All right. So I kind of like to start off by talking a little bit about what I call superpowers. Mm-hmm. All right. There's specific industries that get to do things no other industry gets to do. Okay. Oil's one. Banking is one. I can't spell to save my life. Insurance is another one. Okay. So oil gets, and I'm not going to get into the oil and banking a whole lot, but so oil creates what's called intangible drilling costs. For every dollar that you spend drilling a well, you can receive $1 of IDCs, and you can offset any other amount of income. No other industry gets to do this. It's specific to oil. Banking gets to do what's called fractional lending. All right. I can deposit $1,000 at a bank and they can turn around and loan out $10,000 and charge interest on $9,000 they never had. That's a pretty cool superpower.
Mm-hmm.
Insurance gets to create something called excess. And in order to understand insurance, I'm going to walk you through a very simple explanation of how taxes work, right? So first, we receive, and I'm going to write large enough for people to be able to see it.
Jason,
Yeah.
Is my writing big enough that it's easily read?
Yeah. Revenue.
All right. Awesome. So when we have money come in to any of our companies, it's considered revenue by the IRS.
Yep.
We subtract out our expenses, and what does this equal?
Profit.
And profit generates
Taxes.
Now, what if money coming in was not called revenue? That means my profit does not generate taxes. Now, this might seem like, what the hell are you talking about? All right. Why would money to an insurance company not be considered revenue?
Because they have to have money on hand in case there's a loss.
Exactly. So what people don't realize is the premium you pay is not revenue. All right. So this is the only type of company in the world that gets to receive money and not have it count as revenue. All right. Now, do we operate in a caste system where only one group of people are allowed to have to own or to control an insurance company? No.
anyone can.
Anyone can. All right. Now, one other quick thing, right? If anybody ever tells you that they can help you avoid taxes, they're probably going to get you in trouble. There's only one time in which it's legal to avoid taxes, and there's two ways. And this one time is at death, and the two ways are what's called a step up in cost basis and the death benefit from a life insurance policy. Other than that, you cannot avoid taxes. All right. But the government loves for you to defer taxes.
Mm-hmm.
We know this because there's a 401k, there's a 403b, there's a 408 and a 408b. By the way, this is an IRA. This is an annuity. All right. It goes on and on. All these sections, these are all sections of Title 26. They're all programs designed to allow you to defer taxes for what?
Retirement.
All right. Now, the government also has other programs. One of them that we specialize in is called an 831B. And 831B allows you to defer taxes to mitigate risk. All right. So same thing as a 401k. It's in Title 26, which is all the laws pertaining to revenue. And just like with a 401k, you go to section 401, paragraph K. Instead, here, you're going to go Title 26, section 831, paragraph B. And that's where all the IRS regulations that pertain to this program exist. All right. And what an 831B does, so I can have my primary company. All right. And maybe this is an S Corp. Maybe it's an LLC or P. All right. And maybe this is a roofing company. Now, every time you do a roofing job, are you not incurring risk?
Yep.
Absolutely, right? Are all those risks able to be mitigated by buying an insurance policy from another company.
Nope.
You might think they are, but they're not. There's all sorts of risks that you're carrying that you can't insure yourself for, and the IRS recognizes and understands this. So the IRS will allow you to create an 831B. This is a C Corp functioning as an insurance company. Now, something else, the IRS will allow your primary company to deduct up to $2.4 million per year of insurance premiums. So what does that mean? That means that my C Corp can sell up to $2.4 million of insurance to my primary company. So my primary company moves 2.4 million over to my C Corp. So now I have all this money here. But remember, it was paid to this company in the form of premium. So I just received a $2.4 million deduction. And by the way, I'm using the maximum amount, but we have clients do this with $100,000. All right. This company received the 2.4 million, but it is what?
Not taxable.
It's not taxed. So it doesn't matter whether you want to put 100 grand in or 2.4 million in. You're getting to take that money off of your books. You're not having to buy a Chevy 2500 HD dually. Okay. You're not having to buy a seamless gutter machine that you may or may not need. All right. So what I kind of explain to people, right, is that companies go through stages of maturity, right? And I can't spell that word, so I'm going to try. All right. So in the beginning, you're like just having to fight for every dollar you can make. Then you're going to get to the point to where you have some money left over and you do need equipment. So when the CPA tells you to buy another truck, buy another trailer, maybe a dump trailer, whatever, it's fine because you needed it. But at some point, you're going to get to where you don't really need to keep buying that crap. You might need it down the road. That's fine. But you don't need it right then, that minute. All right. And so what happens is you can take this primary company, you can shift money over to here, right? So you put all this money over here, and then you can use the money here. So this is what's awesome. All right. For the first 12 months, this money is securing an insurance policy. But after that 12 months, there's 3 things you can do with it. And by the way, during this 12 months, this money is invested and growing. After the 12 months, you can leave it invested. 2, you can pay it out to yourself as a dividend. So right now, the top max federal tax rate is 37%. You'll also probably incur 3.8% for Obamacare. And then you're going to have a state tax here in Kansas where we're located. It's 5.5%. But if I move my money over to my C Corp, my insurance company, I hold it for 12 months, it converts to excess, and then I pay it out, I pay 20 to the Fed and 5.5 to the state. I don't have to pay this 3.8, and I shave 17 points off the Fed. Pretty big win. But there's a much bigger win. I can loan it. There's something called the FFR. It's the minimal rate at which money can be loaned and have it be considered a loan. It's 0.0043%. If you throw 1% on top of that, that makes that an arm's length business transaction. And so all this money that you've socked aside into your C Corp that's functioning as an insurance company can all be loaned to where?
Back to your roofing
To
company.
you. And now you've paid 0 taxes. So,
Okay.
one
First,
other thing. Let's say my primary business has 3 owners.
mhm.
We can create 3 831B plans. And each owner will have their own.
That was my first question. So you already answered that. Second question, what if as a business, say I'm a general contractor and I own other businesses, can each entity do their own 831B plans?
Correct. Every entity can have their own plan, and every owner can have their own plan. You're limited in years 1 and 2 to 15% of gross revenue, and in years 3 and on, 10% of gross revenue. But, if you compare this to other things, right? How much money can I put into a 401k or a simple IRA or Roth, right? Almost not. I mean, compared to the fact I could put 2.4 million here. By the way, ERISA laws do not apply, and all your discriminatory laws do not apply. So this isn't like a lot of programs where you have to try and get all your other employees to make use of it. And if they don't, you're limited and all that other stuff. This falls outside of all of that.
Nice. So we talked about like being able to buy buildings and stuff. I assume that's where the loan program comes in.
Yeah, because once it's loaned to you, there's literally nothing you can't do with it. And so this is what we help. This is how we help our clients access the money in a tax-free manner. Now, let's just say I got my primary business over here. I have my insurance company over here, and I've been stacking bricks over here like crazy for a long time. And I've been loaning it back out to my other business or myself. Doesn't really matter. Well, how does that get paid back?
Is it interest only, or how does it work?
Well, the interest is going to be very low. The interest payment is going to be below 1.5%, right? And you're paying the interest back to yourself.
Yep.
So it almost really doesn't matter. This is where you get to play like you're the federal government and keep borrowing money and have it never matter. Until you die. At the point in which you die, all these loans have to be paid back. Well, that sucks, right? So why not have somebody else pay it back for you?
Yeah.
So what we do is we create a life insurance policy, and instead of you funding it, We have a bank funded. So the bank sends their money over to here, you die, and the life insurance money sends the money up to your insurance company to pay off all your loans.
Okay.
And then all the money that's here gets distributed to your beneficiaries.
Now, based on that, would there be any tax consequences? I mean, say there's millions and millions and millions of dollars in there, $20 million maybe.
Yeah, because ready for this? At what
Yeah.
point do you avoid taxes?
Yeah.
And so,
I do, but my beneficiaries, that's what I'm asking about.
Yeah. That's step one. First way is a step up in cost basis. So the value of this company that has all this capital in it that's never been taxed gets brought up to its value at your death and distributed to your kids tax-free.
Okay. Very nice.
I know I kind of did a whirlwind of info. We have a spreadsheet that we can send over to people. I'm going to show it to you here real quick. Do you see it?
Yep.
So this has all of our fees. We charge $5,000 to set it up. We charge $5,000 per year to run it. And then we charge somewhere between 3 and 10% of the amount of money going in. So you can see right here when we send this out to everybody, you can select whether this is the ERM is the first one, is the catch-all, applies to everybody. And then depending on different types of businesses you have, if you want to have us create a warranty program for you, a lot of car dealerships, used car dealerships do this one. A lot of like gun manufacturers do the custom warranty program. If you own storage units, we do storage assurance. If you have rental properties, we do tenant assurance. If you're, dentists, we do that. If you want to be protected from audits, well, every one of our clients we automatically protect from audits, but this is for a much bigger level of protection. But you just come down here, you can click this drop down, you can select what program you want. You can put in the amount of money you think you're going to fund it with for the year, whatever rate of return that you think your money will make while it's invested. The federal tax rate that money would have been taxed at if you didn't do this, right? So if I'm in the 22% tax bracket, I'm going to put 22 in there. If I'm in the 37, I'm going to put 37 in there. Put in your state tax rate, and then you're pretty much done, right? And what this does is over here in these columns, it takes that amount of money in an S corp on the right or LLC, and it shows you pay 42.5% in taxes, and you'd be left with $57,500. If you earned 8% on it for the year, you'd be left with $60,145. Over here, if you did it through the reinsurance company, you're going to pay us $10,000 as a seeding fee, $5,000 to set everything up. You're going to have $85,000 instead of $57,500 left over. You earn your 8% on it. You're going to be left with 90 versus 60. So it's a 30% gain, or actually more than 30%, but it's a $30,000 gain just on a small amount of money, like $100,000, right? Mm-hmm. Now, if I move this to $500,000, you'll notice something. The 10% seeding fee drops down to 8. All right. If I go all the way to the $2,400,000, my seeding fee is now down to 3%. So the more money that you do, the lower we're able to make your expenses.
And the more money you're going to save on taxes, too.
Well, absolutely. And so if you look at this, they have the potential to come out $1 million at $2.4 million. They're going to pick up $1 million in 1 year. Just in tax savings.
Mm-hmm.
So we always tell people the very first step is to keep what you make, right? Once you've kept what you've made, then we can start to deploy it in a much more effective manner for you. But the number one first step's got to be keeping it. Because if you don't got it, there's nothing you can do with it.
Yep.
And I personally don't count buying shit as keeping it. Right?
No.
If I buy something I don't really need and it's a piece of equipment, sure, I can depreciate that. I can get some tax savings, but it's much more effective if I could delay that purchase by 12 months, move my money to my insurance company, and then borrow that money back from the insurance company at 1.5% to buy that piece of equipment that I need.
Quick question. So if something happens in the middle of this, that first year, how does that work as far as pulling some of that money?
So let's say you need your money back.
Yeah.
Yeah, you terminate your policies.
Okay.
It's that easy. And because it's your company, what do you think happens to all that money that's over there? It just flows right back to you. Now you're gonna have to pay taxes on it, right? Because you didn't pay taxes when you put it over there.
Mm-hmm.
So there's no real risk at trying to get it up and going.
But that's why the 15% and 10%, those are their part
Yeah,
of
that would be the,
company.
the risk is that you would have paid us, right? So let me go back down to a higher. Let's go to 400,000.
Mm-hmm.
All right. So at $400,000, you'd have paid us 37 grand to get it set up, right? Now, you might think that would be the risk, because if you get 6 months into it and you need your money back, right, you'll have spent that. Well, here's the deal. We guarantee all of our clients on everything we do for them. So not only do we guarantee you against audit, we cover all costs involved to an audit. We pay any penalties from an audit. If somebody ever does something with us and they cancel, we refund all fees. So if you started this off, like, we view it as our job to gain a good enough understanding of you and your business to where if you had to cancel this within 6 months, we're going to consider it was our fault for you to let you do it in the first place. So if we don't think that you should be moving this amount of money into here, we're not going to let you. Remember, we're CPAs, we're attorneys, we're investment advisors. Like, by the time somebody does any of our programs with us, our knowledge of their business is probably better, but a lot of times better than their knowledge of their business. So if somebody enters into this program with us and we screwed up and they overfunded it and they needed that money back, we're going to eat it.
Okay. So, and if anybody wants to get a hold of you guys, you can get a hold of Richard at his email is richard@owlfi.com. So that's OWLFI.com. And he's available also by phone and text at 913-441-8380. Again, that's 913-441-8380. If anybody needs help with their supplements or their or estimates, invoicing, you can get a hold of me at 720-702-1938 or at jason@furtadolaw.solutions. Well, gentlemen, thank you very much. We really appreciate it. And I'm sure this is great information. I'm sure just from your posts on Level the Playing Field, I'm pretty sure you guys are not going to have much time off by the end of the year.
No, we do not allow any vacations at the end of the year because we just slam a number of these through at the very end of the year. So
yeah, it's kind of like us. Part of our corporate policy is like during storm season, unless it's an emergency or it's well in advance, you're not taking a vacation.
Yeah,
because it just, you never know when you're going to get slammed. We had one that one of our associates had already had something planned, and we started getting really busy, and it was like the busiest week we had. We had like 100 new files come in, and she was barely training some other people, and so I had to fill in, and that wasn't my job. So
yeah, Yeah, we feel you, man. We feel you.
All right. Well, if anybody needs anything, you know how to get a hold of Richard and myself. Have a good one.
Thanks. Take care.